Hello, you're welcome to FinInvest Niger. My name is Tom Princeville. I'm a certified securities and investment specialist, and I've been investing for the past 2 decades. So I want to share my little knowledge of how to analyze a company's financial statements for the purpose of arriving at a conclusion that will lead you to either buy, sell, accumulate, or hold the company's share. So in this aspect, we want to look at the fundamental analysis of Veritas Kapital Assurance Plc. Veritas Kapital Assurance Plc, this particular company, is listed under the insurance sector of the NGX. And we want to start with the company's revenue. All right, so the company recorded 27.320 billion naira in revenue in the full year 2025, as against 23.694 billion naira in revenue in the full year 2024. So the revenue here rose from 23.694 to 24.320 billion naira. Now, let's look at the company's profit before tax, rather the company's gross profit. The company made a gross profit of 22.581 billion, 22.58 billion, as against 23.311 billion, 23.311 billion. So there's a slight drop here of about a billion naira from the full year 2024 and the full year 2025 figure. So there's a little drop from 23.311 billion to 22.581 billion naira. So we move down to the company's profit before tax. The company made a profit before tax of 6.623 billion, 6.623 billion, as against a loss after tax of 624.549 million naira, 624.27.459 million. This is approximately 630 million naira, in losses, as against a gain of 6.623 billion naira. Now let's examine the company's profit after tax. The profit after tax figure here is given as 6.459 billion, 6.459 billion, compared to a loss of 1.093 billion, 1.093 billion. So the company recovered from a loss position of 1.093 billion to a profit level of 6.459 billion naira. We want to look at the total comprehensive income, which is 6.459 billion, as against 728.775 million naira. The company recorded a total comprehensive income, and in this aspect it is a loss of 728.775 million, as against a profit of an income of 6.459 billion naira. So we want to look at the company's earnings per share, which represents the most important value in the entire table. All right, because this is what governs both share price increase in the future, as well as the level of dividends the company could pay out. All right, and so you have two figures here, which I'm going to explain. The top one here is 93 kobo, and the lower one is 47 kobo. Please don't go away. Like this video and subscribe to this channel, and also share the content here to people in your community. So in this case, I would take time to explain the two values you have here in the course of this presentation. Now we are through with the the this segment of our analysis, the profit and loss segment, we want to now concentrate on a skeletal summarized version of the cash flow statement as well as the balance sheet. Now, the company has a cash position of 9.426 billion naira, 9.426 billion naira. The company Veritas Capital, is actually rich in cash, considering the fact that, from a mere profit of 6 billion, it's able to generate a cash of 9.426 billion naira. So the company could either buy back shares, embark on tangible projects, or meet up with emergency cash, emergency funding without resorting to expensive, borrowing from the banks. So the company's equity here is 21.694 billion, and equity or shareholder funds simply means subtraction of the company's total liabilities from its total assets. The difference between assets and liability will give you the value here, 21.694 billion naira. We want to go to the company's PE ratio. You could observe two figures here, a PE ratio of 2.44 as well as a 4.83. Now, the matter is this, you see, this is where the entire confusion came in, because these two values are represented in the company's financial statement. In the company's profile, this is the shares outstanding, 13.87 billion is the share outstanding in the company's profile. Then in the company's notes to financial statements, all right, it indicated 6.933 billion. You begin to wonder which one is right. And this has been occurring year in, year out without a resolution to this problem. One company presenting two values, I begin to wonder which one is correct. In the profile, this is the value of the of the number of shares outstanding. In the financial statement itself, this is the value the company presents. So we use both values to calculate the earnings per share. That's why we're having two values, you're having two figures for the earning per shares here. And what's earning per shares is simply a division of the company share price, all right, all over. So it's a division of the company's earnings, that's the profit after tax, divided by the number of shares outstanding. So when you divide the company's profit by this value, you have 93 kobo. Okay, and when you divide the profit by this other one below, you have 47 kobo. That's where the confusion lies. But all the same, the company is still profitable and is still making a decent earnings per shares. And so we want to look at how these two values equally affect the PE ratio. The PE ratio here essentially is the price divided by the earnings. So if you take this particular price now, 2 naira 27 kobo, and divide by 93 kobo, you will have 2.44. All right. And then if you take the same price and divide by 47 kobo, you are going to arrive at 4.83. So that's the essence of these two figures you are seeing. So then for the market capitalization, you also have two figures. What was market cap? Is a multiplication of the share price by the shares outstanding. If you multiply this by this, you will get this. If you multiply this by this, if you multiply this by this, you have this. So the two values are still there. Because of what? This is what brought the discrepancy, the number of shares outstanding. This is very, because this particular parameter could really affect other factors, other values in the in the table itself, in the entire analysis. So this is a PE ratio. All right, the company is quite cheap by this parameter, or by this parameter, the company is still cheap. All right, it's still a cheap company. And considering all what you've said so far, although the entire exercise here, is for academic purpose and also for entertainment, but I will not conclude without giving these making my recommendations about this company. So this company, Veritas Capital Assurance, I'm giving it a buy recommendation. All right. Why is it a buy? It's because of the recovery from a negative earning per share to a positive earning per share. Number one. Number two, it has a cash reserve here. And number three, the balance sheet is very strong. Number four, the earning per share is not is quite is inexpensive. It's not too high. Okay, so I'm giving this company a buy recommendation, and let's hope and believe that the performance continues like this. Then of course you stand to have a sizable level of capital gains at the end of the day. Thank you very much for watching. You could also access other videos in my channel as well.